Hey everyone, me Kevin here. So, are we going into a recession? Almost every YouTuber or financial media outlet is saying, that's it. The 10-2 has inverted, and don't worry if you don't know what that means, I'll give a brief explanation on that. And they're saying, that's it. We're definitely going into a recession. Circle the wagons, because folks, there's nothing we can do anymore. Every single time in the past that the 10-year and the 2-year treasury curve has inverted, we've been screwed, and we've ended up going into a recession. But there are three things that can actually explain an inverting yield curve. One could be the Fed has lost all potential faith by markets. Number two could be we are going into a recession. And number three could be this is what you would expect to happen in this market. And then, of course, there are going to be hints and tools that we could use to tell us which one of those three scenarios this is likely to play out. That is this just a sign that people don't believe the Fed anymore? Is this a sign we're going into a recession? Or is this what you would expect to happen? So, let's break this down. First and foremost, when we consider the 10-year and the 2-year yield curve, we have to understand what those things individually represent. First and foremost, if you had $10,000 and you said to the government, hey, I'm going to give you $10,000. Just pay me interest while I lend you that $10,000. And at the end of, let's say, 10 years for a 10-year treasury bond, give me my $10,000 back. And the way this would work is you take about $10,000, and the government might say, hey, we'll pay you 2.5% or $250 per year for 10 years, which is great because that's $2,500. And that would mean that you have earned $2,500 on top of your $10,000 for 10 years. Now you can buy and sell this bond, but basically that's what the 10-year bond is, right? If you get 2.5% for the 10-year, then what if you only agreed to lock up your money for 2 years? Well, you would expect to get paid less money, maybe only $180 per year for 2 years. Because at the end of those 2 years, you could take your $10,000 back and you could go do something else with it, right? So you would expect to get less money because you're taking less market risk, locking your money up for less time. Again, you can buy and sell these bonds, but if you don't hold them to duration, you're subject to market risk. And that means if other people all of a sudden are selling the 2-year bond like crazy, the value of your bond, if you were to sell it, plummets. And that's really, really bad if you're holding that 2-year bond, right? So assuming you want to hold these to duration, the full term, you would then, of course, expect that maybe a 1 year would only pay you like 1%. Because again, you're taking less risk, so you would expect to get paid less. So why? Why would it then make sense ever for potentially, instead of getting paid 2.5% on the 10 and 1.5 or 1.8% for the 2, why would it ever make sense for all of a sudden the 10-year yield to be 2.5% per year? And let's just say, I'm going up a little higher than what is actually happening right now. Let's say the 2 years paying you 3%. Why would that make sense that you're getting paid 3% for the 2-year and only 2.5% for the 10? Well, it would make sense if you want the value of your bond to maintain some value over the next 2 years and you're investing in 2-year bonds during a time in which other investors are actually selling the 2-year bond. Because if you get a lot of people selling the 2-year bond, that's going to lower the price of that bond. And anybody holding that 2-year bond is going to lose money if they want to trade it. People don't want to lose money. So, in other words, people right now in the market are having to be compensated a higher amount in order to take the risk on the 2-year bonds. So why is that? Well, there are a few reasons, and the big predictor tends to be, okay, well, when the 2-year is getting paid more in yield than the 10-year, well, that's a sign that we probably have a bad market coming up within the next 12 to 24 months, right? I mean, look at the past times that the yield curve has inverted. We had an inversion right before the Paul Volcker era, right in the late 1970s and early 1980s. We had some ugly recessions in both circumstances here. In fact, on the St. Louis Fred, we see 2 plotted recessions demarked by those gray bars. You see the inversion here in about 88, 89, and a recession right after that in the early 90s. You see an inversion over here in about 2000, and of course the dot-com bubble recession. Another inversion over here in about 06, and what do you get? The Great Recession. You get an inversion over here in 2019, and oh my gosh, sure it was a pandemic-caused recession, but you still had a recession. And so here we are again, inverting again. That makes us feel like, looking at just this chart, that crap, this is a sign the market is pricing in that we could have a poopy-doopy economy in a year to 18 months to a year and a half. And people who are investing in 2-year bonds want to be compensated more for taking that risk. Okay, so because if we're in a recession, bonds will probably sell off, stocks will probably sell off, so that makes sense. We probably aren't able to anticipate that we'll be in a recession in 10 years, right? So we're not going to go out to the 10-year and all of a sudden demand much more money for that because we think we'll be through whatever turmoil we're in right now. So that's usually how the 10-2 works. But wait a minute. What if the reason we're seeing the 2-year demand such a high premium is because we're actually on an aggressive interest rate hiking path? What that means is we believe that interest rates are going to be about 2% by 2023. So let's actually write down that right now in 2022, in Q1 2022, we're at 0.25% for the Fed's interest rate. But what if in Q1 2023, interest rates are actually at 2.25, and then in Q1 2024, interest rates are 3%. Well, if those are what the Fed's interest rates are, then you better be demanding a big fat premium for those 2-year bonds. But wait a minute, do we actually think the Fed's going to have rates this high, this long? No. In fact, most estimates say that by Q1 2025, we're actually going to see those interest rates maybe come back down, maybe back down to 2%, where the Fed relaxes the interest rate hiking cycle, assuming that eventually these supply chain issues repair themselves and inflation goes down. So in this dynamic, if we actually draw this out, let's draw this. We're very, very low right now. We're going to go very, very high within about 2 years. Then we'll probably begin a loosening cycle and head back down. And what's very interesting about this is close to us, that is like the closest bond we could get to us is going to be a really short-term bond, right? Like maybe a 3-month bond, right? The one that probably aligns most with the peak of the Fed's rate hike cycle is the 2-year, which means the one that has the most market risk is the 2-year. And the 10-year or even the 5-year are probably way, way, way out there at the end of the curve, right? Let's just go with the 10-year for now. So now you realize, based on the Fed's rate hike cycle, that you're going to have to demand big, big, big premium in interest rate for that 2-year, because you're going to be having that 2-year at a time when the market, if you needed to sell this bond, has high interest rates and the value of your bond could be very, very low. Again, remember this, if you lock in a bond, a 2-year bond at 2.5%, but the Fed's at 3%, well, the 2-year bond on the market might actually be trading for like 3 or 4% interest. That means yours at 2% is worthless, like literally worthless. You're taking a lot of market risk, right? So this is interesting because in the prior chart, we saw that a recession is always predicted by this 10-2. But if we now consider, have we had an era where the 10-2 has inverted, during which time we also expected, in a really weird way, that interest rates would go up for a couple years, peak, and then come down. See, in the late 70s, we thought inflation was entrenched, that inflation was going to stay forever, and we had to go through a nasty recession to actually get that inflation out. But the market's actually pricing in, to some degree, that the Fed's going to be right, that inflation's going to come under control. But wait a minute. Let's go back to those 3 things that I mentioned could happen. Number 1, we could have a recession. That is a proper predictor of the 10-2, right? We could also have a loss of faith in the Fed, and we could have normal market dynamics. So while I wrote this a little bit out of order, we talked about number 1, the chart showing we should be seeing a recession, right? We actually also talked about number 3, that it would make sense that you're demanding a higher rate for the 2-year, given the Fed's rate hike cycle path. But what about the third potential? Well, the third potential is this. The chart here that Fed rate hike cycles that don't end in recession are actually quite rare. That is, almost every time the Fed raises rates, over here in the early 70s, over here in the early 80s, over here in the late 80s, over here in the dot-com era, over here in the Great Recession period, And of course, over here, going into about 2018-19, ended up leading to that 2020 recession, right? Those are all instances where the Fed started hiking, and at some point we hit recession. Interestingly, we usually hit a recession when the rates kind of start trending down, or when the rates peak, which is very interesting. Like you see that right before '08, that sort of peak. You see that right before the dot-com era. You see that right before the '89 recession. So it's almost like the Fed has to go through its rate hike cycle. During the rate hike cycle, the economy's still growing like crazy. It's actually still growing great. That's why they're hiking, because we're almost growing too fast. They stop hiking. And it's the point when they stop hiking that you're actually potentially closest to a recession, because that's when they're like, oh, okay, yep, we're achieving our goal. We're slowing the economy. Ah, crap, we slowed it too much, recession. Now, there have been two cases over here in the mid-'80s and over here in the mid-'90s where the Fed was able to do what's known as have a soft landing, to stick the landing, to raise rates and then lower them without having a recession. It's just more rare than not. And so that's potentially why markets are saying, yeah, no, 10-2 is inverting, because we are going to see a recession. So if we go back to this chart over here, or this right down here, this loss of faith in the Fed and recession, this is almost one and the same. The markets are saying, yeah, no, we're going to have a recession. But it also entirely makes sense, based on the Fed rate hike cycle path this time, that normal market dynamics would invert the 10-2 curve. And that, yes, I hate this phrase, but yes, this time could be different. But wait a minute. We don't just want to be blind and say, oh, this time can be different. I mean, come on. Like, when we talk about this kind of stuff in our courses, I always talk about, hey, you've got to have your eyes open to all of the potential different scenarios and the indicators that would tell you which path that you're on. And so let's try to understand which path we're on now and how that maybe compares to different paths. And this is what you got to pay attention to. Inflation expectations. That's it. I know that sounds crazy, but there are two ways you can measure this. One, you measure inflation expectations by consumers. Number two, you measure inflation expectations by looking at the 5-year Treasury break-even. If the line on the 5-year break-even is going down, that means inflation expectations are going down. The last week, they've actually been going down. The inflation expectations for consumers are ironically anchored right now. They were not when we got Paul Volcker. And remember, going back to this chart right here, how I told you that the 3-month would probably not see as much of a premium as the 2-year? Here's another curve that you could pay attention to. It's also another recession indicator, and it's on this chart right here. It's called the 3-10 yield. Look at this. All of the curves are inverting. The 5s, 10s, the 2s, 10s, the 10s, 30s, like all these longer term ones are showing some form of inversion. But what's this? A very popular predictor of recession. The 3-month 10-year is actually not predicting a recession. In fact, it's going entirely the opposite direction. Why, folks? Well, because this curve right here, this path that we're on of rates going up and then rates expected to come down, we haven't seen before. In the past, we've seen inflation expectations out of control. We've believed that, oh no, the Fed's going to hike rates and then they'll never come down again. But now the market's already pricing in this decline. And so in other words, we pay attention to that 3-month 10-year. We pay attention to the inflation expectations. And yeah, the inversions in the other curves might deepen. But as long as inflation expectations remain anchored, maybe there's a chance we can actually avoid a recession. So again, pay attention to inflation expectations by consumers, by inflation expectations in the market via the 5-year break even. And then, of course, pay attention to a wage price spiral possibly happening. Last labor report said again, no wage price spiral, 4.8% year over year, or month over month annualized, right? Big deal. And number 4, of course, CPI, month over month. So we got to pay attention to all of this. Anyway, thanks so much for watching. We'll see you in the next one.